What if I told you that the future of your investment portfolio could depend on the right stock in one of the most exciting sectors of today's market? From cutting-edge semiconductors and biotech breakthroughs to the roller coaster world of e-commerce. Today, we're diving into 9 stocks that could either skyrocket or flop in the years ahead. But which one is worth your attention? Let's find out. Hi. In today's video, we're going to explore the future potential of 9 stocks, each with its own unique opportunity and risk. We'll break down AOSL, BBIO, BPMC, CVNA, HOOD, LTH, MSTR, MXL, and RIGL, looking at where they stand in their industries and what they mean for your investment future. Thank you for watching, and please subscribe to my channel, TheFinanceSavvy, for more updates and insights. If you have any questions, feel free to reach out. Let's dive into the video. Stock analysis, AOSL, Alpha, and Omega Semiconductor. First up, we have AOSL, a leader in the semiconductor industry. If you've been following the rise of tech, AI, or electric vehicles, you know that semiconductors are absolutely crucial. And AOSL is making waves by providing power-efficient chips used in everything from industrial machines to your everyday devices. The company is positioned at the cutting edge of energy-efficient semiconductors, which are in high demand. What makes AOSL stand out? The global push towards sustainability and green technologies means that their products are becoming essential for powering electric vehicles, renewable energy grids, and even AI-driven systems. And let's face it, semiconductors are here to stay. In fact, we're going to see even more demand as technologies like 5G, AI, and electric cars continue to grow. Verdict: AOSL has great growth potential in the semiconductor market. They're part of a high-demand sector and are well-positioned to capitalize on future trends. Overview: AOSL is a global semiconductor company that designs, develops, and supplies power semiconductors. Its products are used in a wide range of electronics, including automotive, industrial, and consumer devices. Long-term potential: the semiconductor industry is crucial to nearly every technological sector, from consumer electronics to electric vehicles, EVs, and AI. Power semiconductors are essential for energy efficiency and are poised to see strong demand in the years to come. Given the increasing demand for electric vehicles, renewable energy technologies, and computing, AOSL is well-positioned for long-term growth. Investment outlook: positive. The semiconductor industry is cyclical, but given the demand for energy-efficient technologies and AOSL's diversified product range, it should continue to perform well in the long term. 2. Stock analysis: BBIO, BridgeBio Pharma. Next, let's talk about BBIO, a company in the biotechnology space. Now, biotech can be a high-risk, high-reward area, but BridgeBio Pharma has caught my attention with its focus on treating genetically driven diseases, an area that is expected to see massive growth. Think rare genetic disorders, cancer therapies, and genetic medicine. If they can get their products through clinical trials, the rewards could be enormous. Biotech companies like BBIO can be volatile. Why? Because you're essentially investing in hope. Hope that they find a cure or that their treatment passes the FDA. However, as rare diseases continue to gain more attention, BridgeBio's innovative therapies could lead to massive success, especially with the increasing demand for personalized medicine. Verdict: moderate risk, but if their pipeline succeeds, BBIO could become a leader in the rare disease space. Worth keeping an eye on. Overview: BridgeBio focuses on discovering, developing, and commercializing medicines for genetically driven diseases. It's a biotech company with a pipeline targeting rare genetic disorders and conditions with high unmet medical needs. Long-term potential: the biotech sector has tremendous upside potential, especially in rare diseases and genetic disorders where innovative therapies are needed. However, the industry is highly volatile, dependent on FDA approvals, clinical trial results, and the regulatory environment. BridgeBio has promising research, but it faces the risk of long product development cycles and high costs. Investment outlook: moderate. High reward but high risk. If their pipeline succeeds, it could be highly lucrative, but biotech is a speculative sector and can see significant volatility. 3. Stock analysis: BPMC, Biomarin Pharmaceutical. Speaking of biotech, let's look at BPMC, another heavy hitter in the biotech/pharmaceutical space. BioMarin specializes in rare diseases, and they've had some major successes like their hemophilia and dwarfism treatments. This company's proven ability to bring drugs to market gives them a solid foundation, but the biotech world is never predictable. The good news? The rare disease market has huge growth potential, and BioMarin is sitting on a goldmine of treatments for conditions with no current cure. If you're looking for stability in the biotech space, BPMC might be a good choice. With its existing products generating strong revenue and a promising pipeline, the long-term outlook is bright. But, like with any biotech company, they'll need to navigate the regulatory hurdles. Verdict: strong long-term potential in the rare disease market, with moderate risk due to regulatory challenges. Overview: BioMarin is focused on the development of therapies for rare genetic diseases. They are known for their treatments in hemophilia, dwarfism, and other genetic disorders. Long-term potential: BioMarin has a strong pipeline with a focus on niche rare diseases, which often comes with high pricing power and limited competition. They have established therapies that generate solid revenue and a growing portfolio. Investment outlook: positive. The company has a robust pipeline, a history of successful treatments, and is well-positioned in the rare disease market. The long-term potential is solid, although regulatory hurdles and high R&D costs can add volatility. 4. Stock analysis: CVNA, Carvana. On to something completely different now. CVNA, or Carvana. This e-commerce disruptor in the used car market has been the talk of Wall Street in recent years. What makes Carvana stand out? They've taken the used car buying process online, making it fast, easy, and, most importantly, contactless. Given the e-commerce boom during and after the pandemic, it's easy to see why Carvana's stock took off. But here's the thing: Carvana isn't yet profitable, and it's fighting stiff competition. Other players like Verum and Shift are trying to grab their market share, and even traditional dealerships are getting into the digital game. Plus, Carvana's business model is incredibly capital-intensive. Verdict: moderate to negative. Carvana's growth story is appealing, but it faces major profitability hurdles and competition. Proceed with caution, especially if you're a long-term investor. Overview: Carvana is an online used car retailer that offers a tech-driven approach to buying and selling cars. Their business model includes direct-to-consumer sales with home delivery. Long-term potential: the online used car industry has gained traction, especially post-COVID. Carvana's innovative approach has disrupted the traditional used car market. However, Carvana faces heavy competition from both traditional dealerships and new digital platforms like Verum and Shift. Additionally, the company has struggled with profitability, and its business model is still in the early stages. Investment outlook: moderate to negative. While the e-commerce model for cars has long-term potential, Carvana's profitability issues, combined with the capital-intensive nature of its business, could hinder its ability to scale and succeed in the long term. It faces increasing competition in the space, making it a riskier investment. 5. Stock analysis: Hood, Robinhood. Next, let's talk about Hood, the fintech pioneer that revolutionized retail investing. With its no-fee model, Robinhood made stock and crypto trading more accessible to the everyday investor. But recently, the stock's been under pressure. The question is, can Robinhood maintain its market share, especially with competition from firms like Charles Schwab and Fidelity? Robinhood's appeal is clear: easy-to-use app, low fees, and access to stocks, options, and cryptocurrencies. However, Robinhood's dependence on volatile market conditions means its success may fluctuate. For instance, if fewer people are trading during a market downturn, their revenues can drop. So, while Robinhood could benefit from continued retail trading enthusiasm, it's not a guaranteed winner. Verdict: moderate. The retail investing trend is strong, but Robinhood's long-term success will depend on how it adapts to competition and regulation. Overview: Robinhood is a financial technology company that provides commission-free trading for stocks, options, and cryptocurrencies. It has revolutionized retail trading by making investing more accessible to everyday users. Long-term potential: Robinhood benefits from the ongoing rise in retail investing, with a large user base and strong brand recognition. However, The company faces increased regulatory scrutiny, competition from other brokerage firms, and reliance on volatile market conditions, e.g., trading volumes and interest in crypto. The market could continue to be unpredictable, and Robinhood's future depends on how it diversifies and enhances its offerings. Investment outlook: moderate. Robinhood's future is uncertain. While its user growth has been impressive, regulatory risks and competition from firms like Charles Schwab, Fidelity, and even crypto exchanges could limit long-term growth. 6. Stock analysis: LTH Latham Group. Now, let's take a turn towards the more traditional sector with LTH, a company focused on pool products and home improvement. Latham Group manufactures pool liners, covers, and other related products, making it a player in the building products industry. The market for pools has been expanding, especially post-pandemic as people invest more in their homes. But here's the issue. LTH is somewhat limited by the niche market of pool products. While home improvement has been a steady industry, there's less room for explosive growth compared to tech, biotech, or green energy. Additionally, economic slowdowns or downturns in housing could hurt demand for pool products. Verdict: negative to moderate. While the pool market is stable, LTH lacks the growth potential of other sectors. Overview: Latham Group is a leading manufacturer of pool liners and covers, as well as other pool-related products. It's a relatively small player in the broader building products industry. Long-term potential: the home improvement and pool product sector tends to be more stable, but growth is limited compared to tech-driven or healthcare-driven industries. LTH is heavily reliant on the housing market and consumer spending on discretionary goods. While pools have become a popular investment for homeowners, it's a niche market with less room for expansion. Investment outlook: negative to moderate. Limited growth potential compared to sectors like tech or biotech. Consumer trends and the housing market will significantly influence performance, making it less attractive for long-term growth. 7. Stock analysis: MSTR, MicroStrategy. Let's shift gears and look at MSTR, or MicroStrategy. Now, you may know MicroStrategy as a software company, but lately, it's been in the headlines for something entirely different: Bitcoin. The company has invested heavily in the cryptocurrency, making MSTR a Bitcoin proxy. So, if you're bullish on Bitcoin long-term, MicroStrategy could be a fascinating play. However, this strategy is risky. Bitcoin's price is incredibly volatile, and MicroStrategy's stock has followed that pattern. But if you're willing to take on that volatility, MSTR offers a unique way to invest in Bitcoin without actually buying the cryptocurrency itself. Verdict: moderate. If you believe in Bitcoin's long-term future, MSTR might be a high-risk, high-reward investment. If not, it's better to avoid it due to its volatility. Overview: MicroStrategy is primarily a software company specializing in business intelligence solutions, but it has gained significant attention for its massive Bitcoin holdings. The company has taken a strategic bet on cryptocurrency as a store of value. Long-term potential: MicroStrategy's bet on Bitcoin is both a strength and a risk. If Bitcoin appreciates, the company could benefit enormously. However, the volatility of cryptocurrency markets presents a significant risk to the company's future. Their core business, software, has a solid foundation, but it is overshadowed by their cryptocurrency investments, which may or may not pay off. Investment outlook: moderate. The company's software business has a reasonable long-term outlook, but the heavy reliance on Bitcoin introduces high volatility and risk. Investors must be comfortable with the unpredictability of Bitcoin's price. 8. Stock analysis: MXL, MaxLinear. Next up is MXL, a semiconductor company that specializes in broadband and wireless communications. As we continue to roll out 5G and upgrade our internet infrastructure, companies like MaxLinear are in a prime position to benefit. They're in the business of providing the essential components for faster, more reliable communication. With 5G becoming mainstream and the Internet of Things, IoT, rapidly expanding, MaxLinear is well-positioned for long-term growth. And with demand for high-speed data only increasing, their future looks promising. Verdict: positive. MaxLinear's position in the growing 5G and communications markets makes it a solid pick for the future. Overview: MaxLinear is a semiconductor company that provides solutions for broadband communications, networking, and RF radio frequency applications. They serve a wide range of industries, including cable, satellite, and wireless communications. Long-term potential. MaxLinear is in a high-growth sector with increasing demand for broadband and communications technology, especially in the 5G era. Semiconductors related to broadband infrastructure should see strong demand as telecom companies and consumers upgrade networks and devices. Investment outlook. Positive. The demand for 5G and high-speed internet should drive strong growth for MaxLinear. As a player in the broadband space, they are well-positioned for the future, although they could face competition in this growing but crowded market. 9. Stock analysis. RIGL, RIGL Pharmaceuticals. Last but not least, we have RIGL, a biotech company focused on immune diseases and cancer treatments. RIGL is developing therapies for conditions like autoimmune diseases, cancers, and blood disorders, which puts it in a high-stakes, high-reward position. Biotech companies like RIGL can be risky because they're entirely dependent on the success of their clinical trials and regulatory approvals. But if one of their drugs hits the market, the rewards can be monumental. The immune disease and cancer markets alone are multi-billion-dollar industries. Verdict: moderate to negative. RIGL has potential, but it's still navigating the biotech risk and reward cycle. Keep an eye on clinical trial updates if you're considering this stock. Overview. RIGL is a biotechnology company focused on developing innovative therapies for autoimmune diseases, cancer, and other conditions. Their primary focus is on immune-mediated diseases and cancer treatments. Long-term potential. The biotechnology sector, particularly in autoimmune diseases and cancer, has substantial growth potential. However, RIGL's pipeline is still in development, and the company faces the usual biotech risks of regulatory approval and clinical trial success. Competition from other biotech firms in these areas could also affect their market share. Investment outlook. Moderate to negative. While RIGL has promising therapies, it is still in the high-risk phase of development. As with other biotech firms, the upside is significant, but the risks, delays, regulatory hurdles are also high. Summary and best investment. Best long-term investment. AOSL, Alpha and Omega Semiconductor, and MXL, MaxLinear, stand out as two solid long-term investments. Both are in the semiconductor industry, which has strong growth potential driven by demand for computing power, 5G, and renewable energy. While semiconductors can be cyclical, their critical role in AI, electric vehicles, and infrastructure gives them long-term upside. Worst long-term investment. LTH, Latham Group, appears to have the least long-term growth potential. While stable, it is in a niche market with limited scalability compared to tech or biotech sectors. Moderate risk-reward investments. BBIO, BridgeBio Pharma, BPMC, BioMarin Pharmaceutical, RIGL, RIGL Pharmaceuticals, and Hood, Robinhood, all carry moderate to high risks due to their volatility and dependence on industry-specific factors, regulatory approval for biotech, competition for Robinhood. However, they also offer substantial upside if they succeed in their respective sectors. So, which of these stocks is the best pick for your long-term investment strategy? It really depends on your risk tolerance and sector preference. If you're bullish on semiconductors, AOSL and MXL stand out. For biotech enthusiasts, BBIO, BPMC, and RIGL offer some exciting potential. But remember, biotech is always a risky bet. For those interested in e-commerce, Carvana and Robinhood could be interesting, but proceed with caution due to the intense competition and market volatility. Let me know if you need further details on any of these stocks or industries. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to The Finance Savvy for more insights. Got questions? Feel free to reach out. We'd be happy to help.